So the focus is usually on what to buy or what to own, but today Sim's going to talk about what she doesn't own in her portfolio. My first question for you is, why talk about what you don't invest in?
So I actually picked up this idea for this article from another article I wrote on complexity bias. And that's the notion that investors often think that we need every asset class under the sun to be successful. It's been researched extensively that this is definitely not the case. And I wanted to kind of put my 2 cents into it to talk about some popular assets that I don't currently hold.
You mentioned assets, so we'll move to gold first. Yeah. Despite recent volatility, gold had a great run last year. So why do you skip it?
So I think, look, gold has definitely shown some merit as a safe haven during times of market turmoil. Ultimately, my decision sort of comes down to the fact that it's not a growth asset. So it doesn't pay dividends, it doesn't make profit or loss. Its inherent price is really based on someone willing to pay a higher price than what you bought it for. And that's kind of where my discomfort really stems. So the only way to sort of generate a positive return is to sell it to someone like that, right? I also think there is a broader point to be made here about whether long-term investors really need assets that are sort of low correlation. Equities have risen substantially over the past few decades, and holding assets that are low or negative correlation to this, for me, it doesn't really make sense as a long-term investor.
So we'll move to bonds now, and this one might be less controversial for, say, younger investors, but why do you still have zero exposure?
Traditionally, the role of bonds has sort of been 2 things, right? And that's one, to generate income for its holder, and secondly, it's been to reduce portfolio volatility. Now, whether or not it's been able to, achieve these things, or whether it's the best tool to do so, that's definitely up for debate. It's also no secret that over the long term, bond returns have paled in comparison to equities. But of course, we know that past returns don't dictate future performance, so I think there's a little bit more thought to this, right? The main reason that I don't have bonds in my portfolio is that their function doesn't really align with what I hope to achieve as an investor. As a growth investor, I have decades of earning potential in front of me. So my main objective is as much exposure as I can to growth assets. Obviously, this will come at the expense of higher volatility and steeper drawdowns, but that is a trade-off I'm currently willing to accept. In saying that, it's important to know I've already established an emergency fund and don't really have any short-term goals I'm focused on. So I can't really justify allocating a significant defensive portion to my portfolio, given, all you're sort of trading off is experiencing lower volatility and smaller drawdowns. That's not really an all-encompassing sort of suggestion for young investors. It'll really depend on your own risk tolerance and capacity.
We both have some experience dabbling in crypto, bit of speculation in meme coins and things like that. But currently you don't have crypto, so what's the reason for that?
Yeah, I recognise not having crypto is probably a bit contentious for someone of our age bracket, and that's fair enough. The appeal for crypto is quite obvious. You hear all these stories of big winners who bought at the right time, held through all the volatility, and then cashed out life-changing returns, right? But I think the issue I find with it is that we don't often hear from the losers because they're not running to tell the world how much money they've lost, right? So I think, I believe investing is something that's intended to complement my life rather than control it. Ultimately, I don't really want to be checking, my crypto wallet every day to see if some speculative buy I made in the morning has suddenly cashed out, right? So in retrospect, I can acknowledge that holding something like Bitcoin might have provided better risk-adjusted returns for my portfolio. But obviously, that's with the sort of trade-off of having the tenacity to hold through that extreme volatility. And the same can sort of be said in retrospect for several other asset classes as well.
So my final question for you is, what's the takeaway for younger investors in this?
I think the main point I want to make here is that you don't need to own every asset class under the sun to be successful, right? So your portfolio is only a reflection of your own goals, risk tolerance, and time horizon, and no one else's. So I think sometimes it feels, especially when you're younger and there's a lot of news media sort of polluting the financial news space, we find that everyone tends to herd into certain assets. But it's always good practice to examine the why of investing rather than just the end product that you're investing in.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and/or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.